She had spent 4 months looking for a crime. The binders were stacked on her kitchen table, the spreadsheets printed and color-coded by year and account. She had been hired to find fraud, and she had found something. $341,000, distributed across 8 years in careful, uneven amounts, from an account that no one had been watching closely. The money was gone and she could trace exactly where it had gone. What she could not find, what nothing in 19 years of this work had prepared her for, was what to call it when the money had gone exactly where it was supposed to. Her name was Carol Voss. She had been doing forensic accounting for 19 years, the last 11 as an independent contractor, hired by lawyers and boards and insurance companies who needed someone to find the number that didn't belong. She had uncovered embezzlement in a school district, where a business manager had quietly redirected supply funds for over a decade. She had found it in a family business passed down across 3 generations. She had found it in a veterans nonprofit run by a man who used operating funds to lease a boat he kept in Florida and never once sailed. She was good at this work because she had no patience for ambiguity. A dollar that left an account had to land somewhere. The organization was called Threshold. It had been founded in 1994 by a woman named Miriam Feld, a social worker who had survived an abusive marriage in her late 20s and spent the years after building something she wished had existed when she needed it. Threshold offered emergency housing referrals, legal aid navigation, counseling connections, and a financial recovery program that paired domestic abuse survivors with trained volunteers. It had a staff of 6, an annual budget of just under $800,000, and a small board of directors that had mostly been in place for over a decade. The board had hired Carol in January. Their annual financial review had turned up irregularities in a secondary operating account, an older account, rarely used, that the founder had retained signing authority over when she stepped back from daily operations 5 years earlier. Over $300,000 in outgoing transfers, 8 years, no corresponding program records. The current executive director did not know what the money was for. Neither did anyone else on staff. Carol had been asked to find out. She started the way she always started, pulling every statement from the secondary account going back 8 years. The transfers were irregular, sometimes 3 in a single month, sometimes nothing for 6 months at a stretch. The amounts ranged from $400 to just over $11,000. None were round numbers. None matched any vendor, contractor, or program line item in Threshold's official records. They went to individual accounts at 4 different financial institutions, with no common bank and no clear pattern in the timing. She subpoenaed the recipient records through the board's legal counsel. The process took 6 weeks. When the documents came back, she spread them across her dining room table and started at the beginning. The recipients were not living well. Most of the accounts showed the financial texture of people near the edge: overdraft fees, minimum balance warnings, rent payments that cleared on the last day of the grace period. One account had received 7 separate transfers over 14 months, totaling just under $9,000. After the final transfer, the pattern changed. The overdraft charges stopped, the balance held. Carol could see it in the statements. Something had shifted. She pulled the date range and cross-referenced it with Threshold's intake files, which the board had provided. The match was there. A woman had entered Threshold's formal program in the winter of 2017. She had completed intake, received services, and been discharged. The transfers had begun 3 months after her discharge and continued for just over a year. Carol checked another name, then another. Of the 23 recipients she could fully trace, all 23 had been clients of Threshold. They had come through the door, received what the organization formally offered, and left. But the transfers had come after, sometimes weeks later, sometimes almost 2 years later. None of them were logged in Threshold's case management system. None had been approved by the board. None were attached to any grant, any program budget, or any documented request. She spent 2 weeks reconstructing each person's circumstances at the time of the first transfer. Court filings, utility shutoff notices, eviction records, public housing applications, anything that had left a trace. In 11 of the 23 cases, she found evidence of acute financial crisis around the time the money arrived. In 8 others, she found the beginning of stability: a lease renewed, a car loan cleared, a child enrolled in a new school, changes that began within weeks of the first deposit. In 4 cases she could confirm nothing. She ran the same search across all 23. She built a timeline for each: when they had entered the program, when they had left, when the first transfer had arrived. The gaps were never the same. There was no formula. Whatever was driving the decisions was not algorithmic. Someone had been tracking these people after they left. Someone had been paying attention. She thought about what that meant. Someone who had kept their own records, followed former clients after discharge, noticed when they were struggling, and found a way to reach them. She thought about how many hours that would have taken. She thought about the formal program, which helped roughly 40 people a year through approved channels, and about this parallel record of 23 more, kept in secret, over 8 years. There was one case she returned to more than the others. A woman who had received 3 transfers over the course of 4 months, then nothing. The timing aligned with an eviction filing that appeared in public records, followed by a court date, followed by a dismissal. The dismissal had come 2 days after the final transfer. Carol did not know exactly what the money had gone to. She knew the outcome. One recipient had moved out of state within 6 months of receiving the money. Another had legally changed her name the following year. A third had died 8 months before the final transfer to her account, which meant either the payment had been made in error, or someone had continued sending money after the account holder was gone, for reasons Carol could not document. She flagged it and kept going. By March, the picture was complete. $341,000. 8 years. No personal enrichment anywhere in the trail. No offshore accounts, no luxury purchases, no undisclosed property, no hidden income. The money had left Threshold and arrived with people Threshold was built to serve, people who had finished the formal program and then, at some later point, needed something the program no longer provided. She had been hired to find fraud. What she had found she could not name cleanly. It was unauthorized disbursement, a breach of fiduciary duty, a violation of Threshold's bylaws, which required board approval for any non-programmatic expenditure over $500. Depending on how the attorneys read it, it could meet the threshold for misappropriation of charitable funds. None of that was incorrect. None of it described what she was actually looking at. The part of her work she had always trusted was its clarity. Numbers were right or they weren't. A dollar was where it should be or it wasn't. She had built a career on the principle that evidence, properly assembled, would tell you what it meant. She had the evidence. It was telling her something. The thing it was telling her did not map onto any findings she had ever written. She set aside the question of what to call it and went back to who had done it. The secondary account had 2 authorized signers. The current executive director had joined 5 years ago and had no involvement in any of the transfers Carol could document. Every transaction she could verify had been processed manually, paper authorization slips, signed in ink. She had copies of 14 of them. The handwriting on each one was identical. She pulled Miriam Feld's signature from the organization's 1994 incorporation documents and from a donor acknowledgement letter dated 2018. She held them under the lamp on her desk against the transfer slips. There was no question. She looked up Miriam's public record. 71 years old. She still listed Threshold as a professional affiliation on 2 industry directories, though she held no official role. In 2021, she had given a brief interview to a local newspaper for Threshold's 27th anniversary. She had said she didn't measure the organization's success by how many people completed the formal program. She measured it by how many of them were still okay 2 years later. Carol read that sentence 3 times. She had interviewed people who had taken money before. She knew what that looked like in a room, the careful phrasing, the slight recession behind the eyes, the way someone answers the question they wish had been asked rather than the one that was. She thought back to her first meeting with Miriam, months earlier, a standard intake conversation at the start of the engagement. Miriam had been cooperative and composed. She had said she used the account occasionally for small discretionary expenses and hadn't thought to close it after stepping back from operations. She had said this plainly, without elaborating, without apologizing. Carol had noted it and moved on. Reading her notes from that meeting now, she could see exactly what Miriam had done. She had said something true without saying anything useful. She had not lied. She had waited to see how far Carol would get. She did not call the board. She sent Miriam a text and drove to her house on a Tuesday afternoon. The house was small, a single-story bungalow with a well-kept garden and a porch light already on when Carol pulled up, as if Miriam had been watching for her. Miriam answered the door in work clothes. She was shorter than Carol had imagined, small-framed, steady, with the composure of someone who had spent decades sitting across from people in crisis and learned not to add to the weight in the room. She offered Carol tea. Carol said no. They sat at the kitchen table. Carol set one of the photocopied transfer slips on the table between them. Miriam looked at it without touching it. Carol said she was not there to make an accusation. She said she was there because she did not understand what she was looking at, and she needed to before she filed anything. Miriam was quiet for a moment. Then she said, "The formal programs required documentation, eligibility reviews, board approval, grant compliance deadlines. For most of the women who came to Threshold, that process worked. For some, it did not move fast enough. She had met a woman once, years before any of the transfers in the records, who had needed $200 to keep her phone active so her children's school could reach her. By the time the formal request had cleared the approval process, the phone had been shut off and the woman had stopped answering the door. Miriam had never gotten over it. She had not intended to build a parallel system. The first transfer was a single decision. Then there was another woman. And another. She had kept her own records, a handwritten ledger, every name and date and amount. She had it upstairs, if Carol wanted to see it. Carol asked, "Did you take anything for yourself?" Miriam said no. She said it plainly, as a fact, without insisting on it. Carol picked up the transfer slip from the table and put it back in her folder. She said she would be in touch. She stood, thanked Miriam for her time, and drove home. She filed the report 3 weeks later. Completely, accurately, with every piece of documentation she had compiled. She did not omit anything. She did not add anything beyond what the evidence supported. The board acted. The attorneys reviewed the findings. Miriam was asked to formally resign from any remaining association with Threshold. An investigation by the state attorney's office lasted 8 months and ended in a deferred prosecution agreement. No criminal charges, but a formal finding of financial misconduct and a requirement that Miriam make restitution to the organization, structured across 5 years. Threshold did not close. It restructured. The secondary account was dissolved. New financial controls were put in place. The organization continued serving roughly the same number of clients it had before, through the same formal programs. Carol did not think about the case often. She had other cases. She thought about it sometimes, in the way you think about something that was resolved correctly and still does not feel finished. 18 months after she filed the report, she received an envelope at her office. No return address. Inside was a plain note card, unsigned. 5 words, in handwriting she did not recognize. "I still have the house." She sat at her desk with the card in her hands for a long time. She did not know which of the 23 it was from. She did not know if she was supposed to do anything with it. She put it in the back of the file folder she had kept from the engagement. She did not throw it away. # story notes. Fictional. All characters, organizations, and events are invented. The financial and legal mechanisms described are realistic but not drawn from any specific real case.